I just found out about something very strange happening right now in crypto. And honestly, it's something that could trigger the next bear market. Remember a few months ago how everyone was talking about MicroStrategy buying every Bitcoin dip like crazy? They now hold around 650,000 Bitcoin. And for context, that's like 3% of all Bitcoin in existence. On top of that, their market cap was so high that people were seriously debating whether they should join the S&P 500. But here's where it gets wild. In the last 2 months, everything has completely changed. And today, I am going to explain exactly what happened, why this matters to you and your Bitcoin, and why this is basically the biggest lesson in crypto. So first, let me explain what strategy is and how it works, because this is very important to understanding the entire story. Michael Saylor, the co-founder of Strategy, basically pulled off what everyone called the infinite money glitch. Here's how it worked. Strategy took an old business intelligence software company, the kind of boring software company that corporate people use for data analysis, and completely transformed it into what's called a Bitcoin treasury company. Instead of making money from software, which was their main business, they started buying and holding as much Bitcoin as possible. But here's the genius part. They figured out how to leverage the stock market to buy even more Bitcoin. And this is exactly what people refer to as the infinite money glitch. Think about it like this. If you buy and hold Bitcoin, you're just hoping the price goes up, right? But Strategy did something different. They sold new shares to investors, and because everyone was hyped about Bitcoin, people were willing to pay a massive premium for those shares compared to the actual Bitcoin inside the company. Imagine, for example, you own 1 gram of gold worth, let's say $100, but investors pay $280 for a stock that holds that gold because they believe in the company's potential. That extra $180 is what we call the premium. Now, simply replace the gold with Bitcoin. Strategy held Bitcoin worth, say, 100 million, but investors paid 3 times that for the stock, and they used that 200 million premium to buy even more Bitcoin. This created like a self-reinforcing cycle. Stock price goes up because Bitcoin is in bull market, Strategy sells shares at a crazy premium, then they use that money to buy more Bitcoin, their Bitcoin stash gets bigger, stock price goes up even more, and suddenly you have this machine that just keeps printing money, basically. On top of that, Strategy also issued convertible bonds, which is basically debt that can turn into company stock. But here's where it gets really crazy. Normally, when you borrow money, you pay interest, right? But Strategy somehow convinced investors to lend them billions of dollars with close to 0% interest. So why would anyone accept that, right? Because investors weren't betting on the interest. They were betting that Bitcoin would go to the moon and they could convert that debt into Strategy stock worth way more than they initially lent. And it worked for some time, until math finally entered the chat. Let me explain. There was always one flaw in this entire money-making machine, and that flaw was obvious from the very beginning if you could actually thought about it. The premium couldn't stay high forever, because 2 things happened. The first one is that Bitcoin spot ETFs launched. But what does that even mean? It means regular investors could finally buy actual Bitcoin just like buying any other stock fund without having to deal with owning a company. There was no premium needed, no corporate wrapper around it, just pure Bitcoin exposure. And all of a sudden, you didn't need to buy Strategy stock to get Bitcoin. You could just buy a Bitcoin ETF and be done with it. Second, and this is very important, Strategy was constantly issuing new shares at a market rate to raise money. That's called an at-the-market offering, which is just a fancy way of saying that they kept selling new shares directly into the market. But by constantly dumping new shares, they slowly killed that extra hype value. In the end, the stock was trading only slightly above the real value of the Bitcoin the company actually held. And here's the brutal part about this whole situation. When the premium collapses like this, the entire mechanism breaks down. It simply doesn't work anymore. And when it doesn't work, Strategy faces a much darker version of what happens when this whole financial thing backfires. Strategy also has around $8 billion of convertible debt sitting on their balance sheet. Most of that isn't due until 2027 and 2032, so they have some time. But here's where it gets scary. If Bitcoin prices fall significantly, and they already have, or if investors are forced to dump the stock, the share price could get crushed right when the company is most vulnerable. Now, the worst case scenario is that the company might need to sell Bitcoin to pay their debt, and as soon as the word gets out that Strategy is selling, the Bitcoin price itself could go even lower, which will drag the stock price down even more, which will trigger even more selling. It sounds like a death spiral, exactly the opposite of what happened on the way up. On top of that, JPMorgan warned that Strategy might get removed from the MSCI USA index and other major indices. Why? Simply because MSCI is considering whether companies that hold more than 50% of their total assets in cryptocurrency should even be in traditional stock market indices. The logic behind this is that if you're holding more than half of your assets in, let's say, Bitcoin, you basically look like an investment fund, not an actual operating company. And investment funds don't really belong in stock indices, right? And to be honest, if Strategy gets removed, their stock will dump even more. Anyway, the decision is supposed to come around mid-January 2026, so there is some time left for that too. Now, as if this wasn't enough, major Wall Street institutions like BlackRock, Vanguard, and others already have started selling their MSTR positions. JPMorgan itself sold off $500 million worth of shares. Obviously, they chose Strategy shares to get Bitcoin exposure instead of buying Bitcoin directly, but now they are running for the exits. So, what's the lesson here? Well, it's actually pretty simple, I think, and it's something we need to understand in this financial age. Strategy didn't actually discover any infinite money glitch. That was a lie. They just found a premium in the market, and let's say they took advantage of it. Very good. But obviously, premiums don't last forever. Eventually, supply and demand catch up with reality. The arbitrage goes away. And when that happens, you are left dealing with basic math. When you issue debt and stock to buy something super volatile like Bitcoin, and you rely on that asset going up in value to cover your obligations, you are not really creating wealth or real value, right? Obviously it works great on the way up, but on the way down, the mechanism that looked so clever starts to look incredibly risky. Of course, this isn't me saying Strategy is going to fail or that you should never invest in Bitcoin treasury companies. What I'm saying is that don't get fooled by the idea that there is an infinite money glitch out there. There never is, there never will be. Every strategy eventually meets reality. Anyway, that's all I have for today. If you found this video useful, consider subscribing to the channel and let me know in the comments below what you think about this whole strategy situation in Bitcoin.